What are the nuts and bolts of a cash balance plan? What is a cash balance plan? Will one help me out? Probably questions you're asking. Hi there, my name is Kenner French and I'm with VastSolutionsGroup.com, where tax, finance, and artificial intelligence meets for entrepreneurs. Clients have said about us such things as, and I quote, "Over the years you've saved me approximately $1 million," unquote. There are two general types of pension plans: defined benefit plans and defined contribution plans. In general, defined benefit plans provide a specific amount at retirement for each eligible employee, while defined contribution plans specify the amount of contributions to be made by the employer towards an employee's retirement account. In a defined contribution plan, the actual amount of retirement benefits provided to an employee depends on the amount of the contributions as well as the gains or losses of the account. A cash balance plan is a defined benefit plan that defines the benefit in terms that are more characteristic of a defined contribution plan. In other words, a cash balance plan defines the promised benefit in terms of a stated account balance. Now, how do cash balance plans work essentially? In a typical cash balance plan, a participant's account is credited each year with a pay credit, such as a 5-year percent of compensation from his or her employer, and an interest credit, either a fixed rate or a variable rate that is linked to an index, such as a 1-year Treasury bill rate. Increases and decreases in the value of the plan's investments do not directly affect the benefit amounts promised to participants. Thus, the investment risks are borne solely by the employer. When a participant becomes entitled to benefits under a cash balance plan, the benefits that are received are defined in the terms of the account balance. Now, for example, assume that a participant has an account balance of, say, $100,000 when he or she reaches age 65. If the participant decides to retire at that time, he or she would have the right to an annuity based on that account balance. Such an annuity might be approximately $8,500 a year for life. In many cash balance plans, however, the participant could instead choose, with consent from his or her spouse, to take a lump sum benefit equal to the $100,000 account balance. If a participant receives a lump sum distribution, that distribution generally can be rolled over into an IRA or to another employer's stock plan or plan that the plan accepts as rollovers, etc. The benefits in most cash balance plans, as in most traditional defined benefit plans, are protected within certain limitations by the federal insurance provided through what's called the PBGC. How do cash balance plans differ from traditional pension plans? While both traditional defined benefit plans and cash balance plans are required to offer a payment of an employee's benefit in the form of a series of payments for life, traditional defined benefit plans define an employee's benefit as a series of monthly payments for life to begin at retirement, but cash balance plans define the benefit in terms of a stated account balance. These accounts are often referred to as hypothetical accounts because they do not reflect actual contributions to an account or actual gains and losses allocable to that account. How do cash balance plans differ from 401k plans? Cash balance plans are defined benefit plans. In contrast, 401k plans are a type of a defined contribution plan. There are 4 major differences between typical cash balance plans and 401k plans. Here we go. Participation. Participation in typical cash balance plan generally does not depend on the workers contributing to their plan. However, participation in a 401k plan does depend on that, in whole or in part, or an employee choosing to make a contribution to the plan itself. There are investment risks. The investments of cash balance plans are managed by the employer or an investment manager appointed by the employer. The employer bears the risk of these investments. Increases and decreases in the value of the plan's investments do not directly affect the benefit amounts promised to participants. By contrast, 401k plans often permit participants to direct their own investments within categories. Under 401k plans, participants bear the risk of rewards of investment choices. Life annuities. Unlike 401k plans, cash balance plans are required to offer employees the ability to receive their benefits in the form of lifetime annuities. Federal guarantees, by the way. Since they are defined benefit plans, the benefits promised by cash balance plans are usually insured by a federal agency. It's called the PBGC, as I mentioned before. If a defined benefit plan is terminated with an insufficient fund to pay all promised benefits, the PBGC has authority to assume trusteeship of the plan and to begin to pay pension benefits up to limits set by law. Defined contribution plans, including 401k plans, are not insured by the PBGC. Now, if you have any questions or need any specifics or consultation about these plans, cash balance plans, or qualified plans to include 401k plans, profit sharing plans, defined benefit plans, and a whole number of plans, that's what we do. That's one of the big things we do. We utilize artificial intelligence to help us to better help the entrepreneur get towards retirement, limit taxes, mitigate taxes, and also prepare while they're in retirement. Check us out on the web at www.vastsolutionsgroup.com or give us a call at 888-808-8278. It's indeed been a pleasure. Hopefully in some way this has added value to you. If it has, please pass this on. Hopefully this video can some way, shape, or form help one of your friends, colleagues, etc. Again, Kenner French, it's indeed been a pleasure.